As of the market close on Friday, December 19th, 2025 at 4 p.m. Eastern Time, Netflix stock is priced at $94.39 USD, showing a slight uptick of 0.39 or 0.41% for the session. With the markets currently closed this Sunday, December 21, these figures represent the final stance of the streaming leader as it enters a high-stakes week. While a 40-cent move might look like a quiet day at the office, there is a massive undercurrent of tension beneath this $94 level that most retail investors are completely missing. The expectation in the market right now is that Netflix is simply a stabilizing utility, a company that has already won the streaming wars and is now just collecting checks. The reality is far more volatile. We are watching a business in the middle of a massive identity shift, moving away from being a tech-led platform and trying to become a legacy media-style powerhouse through its proposed $82 billion acquisition of Warner Bros. Discovery assets. This single move has fractured the investor base, creating a scenario where the price action you see on your individual brokerage or your Robinhood app is a battleground between those who believe in this massive expansion and those who fear the debt load will crush the company's pristine balance sheet. If you look at your Fidelity trading platform or your Interactive Brokers account right now, you might notice that the $94 handle feels exceptionally low compared to the $600 or $700 range we saw in previous years. That is because of the 10-for-1 stock split that took place just last month. It was a move designed to make the shares more accessible for those practicing self-investing or using platforms like SoFi Invest to pick up fractional shares. However, since that split, the momentum has been decidedly bearish. The stock has dropped roughly 29% from its June peaks, and it is currently struggling to find its footing. While many people think of Netflix in the same breath as Apple stock or Nvidia stock, the trading dynamics have diverged. Unlike Nvidia, which is riding a massive hardware wave, Netflix is currently dealing with the merger overhang. Institutional activity shows a massive tug of war. We saw UBS Asset Management adding millions of shares, while others like GQG Partners completely exited their positions in the most recent quarter. When the big players are this divided, it usually means the market is waiting for a single catalyst to break the stalemate. The dominant narrative you hear on most investing sites is that Netflix is too expensive or that the streaming market is saturated, but the deeper truth involves how they're handling their content spending. Right now, Netflix is trying to swallow a massive chunk of Hollywood by bidding for HBO and the Warner Bros. Movie studios. This is where the tension between expectation and reality hits the hardest. Investors expected Netflix to keep generating massive free cash flow to buy back shares. Instead, reality hit them with a plan to take on $59 billion in new debt to finance this acquisition. For a company that has spent years telling us they are a lean, tech-focused business, becoming a debt-heavy media conglomerate is a hard pill for the market to swallow. This explains why the stock is sitting near its 52-week lows, while other tech names are hovering near all-time highs. It's not just about the numbers, it's about the story. And right now, the story is changing in a way that makes many people nervous. Speaking of the numbers, the recent volume has been telling. On Friday, we saw about 79 million shares change hands, which is significantly higher than the average. This indicates that institutions are actively repositioning themselves ahead of the new year. If you're using Schwab Intelligent Portfolios or other robo-advisors, these small daily shifts might not seem like much, but for active traders on the SoFi trading platform or Interactive Brokers, the breakdown below the $100 psychological level was a major technical signal. Netflix is currently trading well below its 50-day moving average of $111 and its 200-day average of $113. In the world of online investing, being below those levels often leads to a sell-the-rip mentality, where every small bounce is met with more selling pressure. This is a classic example of reality falling short of the bullish expectations set earlier in the year. Beyond the stock price, we need to look at what is actually happening inside the business. Netflix has over 300 million paid members globally, which is a staggering number. No one else even comes close. Disney Plus and Prime Video have large numbers, but their engagement levels and churn rates don't match what Netflix has built. Their ad-supported tier, which was once viewed with skepticism, is now a major pillar of their growth. It's on track to double its revenue this year, and it's attracting about half of all new signups. This is the hidden value that might eventually save the stock. If the ad business can scale fast enough to offset the interest payments on their new debt, then the current price of $94 might look like a steal a year from now. This is why getting professional investment help or doing deep research through your Fidelity Wealth Management or Fidelity IRAs is so important. You have to see past the scary headlines about debt and look at the actual cash being generated by those 300 million people. At this point, I want to pause and get your take on the current situation. Comment below how many shares of Netflix stock you currently hold, or if you're planning to add more at these levels. Do you think the Warner Bros. Deal is the right move for their long-term growth, or is it a mistake that will weigh them down for years? I'm curious to see if you think they can actually integrate HBO and maintain their margins. Looking at the broader market context, Netflix is no longer just competing for your time on the couch. They are moving into live events and sports. We've seen them grab the rights for WWE matches, NFL Christmas games, and even MLB events starting next year. This is a clear attempt to make the service uncancelable. If you're a sports fan, you can't just drop Netflix when your favorite show ends because the game is on next week. This strategy mimics what we see with cable television in the past, but with much better data and lower distribution costs. This is the kind of insight that the average user of a Robinhood app might overlook while focusing solely on daily price swings. They are building an ecosystem that is designed to be a permanent part of the global household budget. For those focusing on self-investing through an individual brokerage or even a Fidelity brokerage account, the key question is whether Netflix is still a tech company or if it has become a value stock. Traditionally, tech companies get higher valuations because they can scale without much extra cost. Media companies have to spend billions on content every year just to keep their audience. Netflix is currently in a middle ground where it has the scale of a tech company but the spending habits of a movie studio. Their recent earnings showed a miss on expectations due to a tax dispute in Brazil, which sent the stock down 10% in a single day. This is the kind of volatility that reminds us why online investing requires a strong stomach. Even a small, unexpected expense can cause a massive re-rating of the stock if the market is already on edge about the company's direction. As we look toward the fourth quarter results in January 2026, the market is bracing itself for more clarity on the Warner Bros. Discovery deal. Paramount Skydance has also made a hostile bid for those same assets, which has created a bidding war that could drive the price even higher. If Netflix has to pay more than the $82 billion currently discussed, expect the stock to face even more pressure. Investors hate uncertainty, and right now there is nothing but uncertainty. On the flip side, if the deal falls through and Netflix walks away with its cash intact, we could see a massive relief rally that sends shares back toward the $110 or $120 range. It's a binary outcome that makes this one of the most interesting setups in the market right now, right up there with the volatility we see in Tesla stock or the swings in Nvidia stock. In summary, the expectation for Netflix was a smooth transition into an ad-supported cash cow business model. The reality has been a messy, debt-fueled attempt at a massive merger that has alienated some of the largest institutional holders. While the core business remains incredibly strong with 300 million members and a thriving ad tier, the financial engineering required to pull off the Warner Bros. Deal has created a massive dark cloud over the valuation. We are currently seeing the stock trade at a price-to-earnings ratio of about 39, which is a significant discount compared to where we were a year ago, but still a premium compared to traditional media companies. Whether you use SoFi Invest, Robinhood, or Fidelity, the key is to watch the debt-to-equity ratio in the coming months. If they can manage the integration of HBO without blowing out their margins, the current skepticism will be proven wrong. The central insight here is that Netflix is no longer just a streaming service. It is trying to become the definitive entertainment platform for the next decade. By combining their global reach with the prestige of HBO and the pull of live sports, they are attempting to build something